Howdy, everybody. Welcome to the Liberty Call for Wednesday, Hump Day, March 23rd. I hope everyone's having a fantastic day out there in the interwebs, if anyone's actually watching. So I'm Raymond Dahlman. I'm your humble host here at DSA Financial Group, and hope everyone's having, like I said, a fantastic day. If it's your first time watching, there's probably a subscribe button right about here, and you could probably give me one of those thumbs up. It's probably right about there if you're watching on YouTube. If you're on Facebook, please like my page and share with friends and family. I would greatly appreciate it. And if you're on any of the other places I disseminate it, don't know what to tell you. So, all right. Beautiful day here in Colorado. Looks like the bad weather has moved past us. So it's in what's the temperature now? 43 degrees here in Larkspur, Colorado. And blue skies. The snow is melting. I didn't even have to go out and shovel or anything. It just melted on its own. It's amazing. So, but we didn't get too bad of a storm on Monday and Tuesday. So, but for those of y'all in Texas, I hope y'all are doing all right. I had some clients who missed their meetings yesterday because the weather was pretty bad. So, but haven't gotten any phone calls or emails that anyone got sucked up in a tornado. So I guess that's good news. So, all right, well, let's go ahead and take a peek at how the indexes did today. Kind of a crappy day in the market. Dow Jones was down 1.29%, closing at 34,358. S&P 500 down 1.23, closing at 44.56. NASDAQ down 1.32, closing at 13,922. Small caps were down 1.5. The VIX was up 2.75% today. It's at 23.57. So the volatility, for the VIX is down right now, which, I see that as, potentially a good thing. When it's above 30, usually means we're in for some real rockiness, but just because it's down near 20, not to say, hey, we're in the clear, we're heading into smooth sailing. It is my personal belief that recessions and bear markets are in our future due to what has happened with, how the Fed has handled things over the last 2 years and how our government's been spending like drunken sailors. And as a former drunken sailor, I find it very offensive the way they spend money. All right, let's look at the other exchanges here in the Americas. Canada was slightly down 0.64. Brazil was up 0.16. Mexico was down 1.02. Getting into Western Europe, Germany down 1.32. UK down 0.22. France down 1.17. Euro stocks down 1.45. Netherlands were down 0.89 and mostly red. Let's see, the worst one I see here is Austria down 2.23. Again, the Russian exchanges are still closed. Getting into Eastern Europe and Asia, looks like, from where's this? Israel and Saudi Arabia and Japan look pretty good. They had up markets. Japan, or the Nike, was up 3%. Australia was up 0.5%, while New Zealand was down 0.84. The Chinese markets, all of them up. The best one was the Hang Seng, up 1.21. And then some of the smaller Asian markets were slightly down. So, but for the trading day of Wednesday, looked pretty good if you were in Asia, and not so good if you were in Europe and then here in the United States. So, kind of a mixed day across the board. But again, that's to be expected. So, all righty. So let's go ahead and jump into a couple of articles I got here. First one, just a market recap. Let me shrink this down. S&P 500 wobbles as banks hit by falling bond yields and on growth worries. Written by Yassine Ibrahim from Investing. Let's go ahead and jump into this. The S&P 500 closed lower Wednesday, led by bank stocks as Treasury yields retreated after rising oil prices renewed worries about the inflation drag on global growth. Crude oil exports from Kazakhstan's Caspian Pipeline Consortium terminal, which are shipped via the Russian port of Novosibirsk, were suspended following weather-related disruptions triggering fresh fears of supply shortages. The move higher in oil prices returned focus to the threat higher inflation poses to global growth, just as investors mull the prospect of the Fed hiking rates more aggressively as it meets in May and June. St. Louis Federal Reserve President James Bullard reiterated on Wednesday the Fed needs to act, quote, faster on raising interest rates as inflation is, quote, way over the central bank's target. The market currently expects the Fed to raise rates by 50 basis points at its May and June meetings. The bets on hawkish Fed exacerbated worries the Fed may overshoot of rate hikes and slow the economy into recession. Well, I don't think there's a way to avoid that at this point. Triggering a fresh flight to safe havens such as bonds. Treasury yields, which trade inversely to prices, fell and weighed on bank stocks. Signature Bank, Wells Fargo, First Republic Bank led the move lower. Tech, which tends to benefit from falling rates, was mostly in the red, though Apple bucked the trend to close up nearly 1%. Apple's iPhone 13 is seeing, quote, stellar demand globally and likely, quote, setting up for monster growth cycle over the next 12 to 18. That's not baked into shares at current levels, end quote, Wedbush said in a note. Adobe Systems fell as much as 9% after its software guidance overshadowed quarterly results that beat on both top and bottom lines and stoked fears about peaking growth. Quote, these results further supported our thesis of peaking net new DM ARR, which we have believed would result in less forward upside to consensus estimates and drive decelerating revenue growth, which we anticipated will weigh on the stock's performance, end quote, Credit Suisse said in a note as it cut the price target on the stock to 525 from 625. General Mills, meanwhile, gained more than 2% after raising its full-year outlook following the better-than-expected quarterly earnings. Meme stocks remained on the comeback trail. GameStop added 14% to its 30% gain a day earlier after GameStop chair Ryan Cohen on Tuesday bought an additional 100,000 shares, expanding his stake in the video game retailer to 11.9%. AMC Weekly was up 14%. In other news, Okta fell 10% after confirming that a hacking group known as Lapsus had carried out a cyber attack, though said security protocols contained the hack. So that's kind of the day in the market. We got people from the Fed, and actually my next article will talk about that. People from the Fed who are keen on raising interest rates much higher than they are currently right now. Although there are some people who are worried we're going to overshoot by raising rates too high and create a recession. Well, here's the thing. I think we're already, we've already painted ourselves into that corner. So I don't really see another way of getting out of this. I know over the last 2 years, the Fed was saying, well, we're trying to create a soft landing, by keeping interest rates low and printing all this money, trying to get out of what's been going on with the supply disruptions created by, the pandemic. And so we'll see. As far as prices of oil, let me go to a bigger screen here. Let's go over to commodities and take a look there. So right now, WTI is trading at 114. And we can just see here on the chart, just in the last, what is this? Oh, this is let's look at a daily chart. So we can see we had a bit of a spike earlier in the month, and then it receded. We were down, in the 90s with WTI, and then now just since, what day is that? The 15th of March. So over the course of a week, we've gone from, mid 90s up to, about 114 on WTI. I imagine the chart is very similar for Brent. Also, gold and silver have had some nice jumps of late. They'd gone down. Their gold had gone down to around 1,900 an ounce, and that it's climbed up about $40 since it had bottomed out. So silver is trading at 25.28. I know in the last few weeks it had slidden back down, or slid's not a word. Silver had slid down into, let's say, the 24 an ounce, and now, like I said, it's trading above 25. All right. So let's see here. Next article: Fed officials nod to big rate hikes to fight inflation. I guess it's better than talking about Russia. So, all right. It's written by Ann Safir and Lindsay Dunsmuir from Reuters. All right. Federal Reserve policymakers on Wednesday signaled they stand ready to take more aggressive action to bring down unacceptably high inflation. Well, we probably could have done that by not printing so much money, including possibly a 0.5 percentage point interest rate hike at the next policy meeting in May. Quote, I have everything on the table right now. If we need to do 50 basis points, 50 is what we'll do, end quote, San Francisco Fed President Mary Daly said at an event organized by Bloomberg. Quote, with the labor market so strong, inflation is the top of everyone's mind, end quote. Daly has been more cautious than her colleagues about policy tightening, and her openness to a bigger than usual rate hike at the May 3rd, 4th meetings shows a rising sense of urgency that swift and concerted action is needed to stop inflation, running at 3 times the Fed's 2% target from getting entrenched. Accelerating inflation has, quote, has necessitated, I think, all of us to think more about how fast they're going to have to go in order to keep inflation under control, end quote. St. Louis Fed President Bullard told the mid-sized bank coalition of America, quote, we have to think bigger, maybe, than we thought about in the past. Bullard was the lone dissenter last week on the U.S. Central Bank's March 16 decision to raise the benchmark overnight interest rate by 0.25 percentage point from the near zero level. Bullard said a 0.5 percentage point hike was appropriate to kick off the tightening, and he wants the policy rate to rise to 3% this year. It's now clear Bullard is far from the lone voice in advocating for more aggressive action, especially given a growing sense that higher oil, wheat, and other commodity prices stemming from Russia's invasion of Ukraine will only worsen the inflation picture while doing little to dent economic growth. Fed Chair Jerome Powell earlier this week said the central bank would move expeditiously to move interest rates up after last week's hike and left the door wide open to a larger jump in borrowing costs at the May meeting. Fed policymakers' forecasts released last week signaled most saw policy rates rising to 1.9% or higher by the end of the year. Quote, I would like to front load some of that, end quote, Cleveland Fed President Loretta Mester said on Wednesday in a call with reporters when asked about the path of interest rate increases this year. Quote, that better positions us if we do it earlier rather than later for what happens in the second half of the year, end quote. Meester wants the federal funds rate to increase to about 2.5% by the end of the year, the levels she sees as neither breaking nor boosting the economy and which would require some 50 basis point rate rises. Markets have taken that view on board, with traders pricing in 2.5 percentage point hikes in coming meetings and a year-end policy rate of 2.25% to 2.5%. Powell, speaking at the National Association of Business Economists conference on Monday, also said May could mark the start of reductions in the central bank's nearly $9 trillion balance sheet, which ballooned during the COVID-19 pandemic as policymakers strove to bolster the economy. Well, let me step aside here. Even while the Fed last week was, slightly raising interest rates, they were still doing quantitative easing and buying toxic bonds off the market and putting them into the Fed's portfolio. So, if you're going to start dropping interest rate or raising interest rates, why don't you go ahead and just stop the QE right now? Why continue it for another month or two, and continue to raise up the amount of securities on the balance sheet? And but hey, no one asks me. I'm just some guy sitting here in Colorado. Anyways, jumping back in, trimming the Fed's portfolio of treasuries and mortgage-backed securities would put further downward pressure on inflation, provided that what Daly said on Wednesday would be the equivalent of at least 0.25 percentage point rate hike this year. I think the data, or quote, I think the data will tell us whether 50 basis points or 25 basis points with the balance sheet is the right recipe, or 50 basis points with the balance sheet, quote, in quote, she said. Daly said she thinks the federal funds rate will likely need to rise above 2.5%, but probably not until next year. Still, she said, quote, we're prepared to do whatever it takes to ensure price stability and in the wake of all the other challenges that we have, end quote. Meester also told reporters there's nothing to stop the Fed from hiking rates and beginning to reduce its balance sheet at the same policy meeting. I think given the situation we're in and the communications that Chair Powell has already made about the balance sheet process, I don't have concerns that That would be destabilizing, and I think we would have to recognize inflation is very elevated, end quote, Meester said, noting that financial markets could handle such a move. Quote, we have to do what we can with both our policy tools to get inflation under control, end quote. Bullard on Wednesday repeated his preference for the Fed to immediately start pairing its balance sheet with asset sales, possibly later on if inflation remained high. All right. So it is good to hear that the knuckleheads who actually run the Fed have come to the conclusion that inflation has really gotten out of control. Who knew? If there was only something they could have done 2 or 3 years ago that would have avoided. Oh, yeah, they could have raised interest rates before all this started, and then none of this would have been a problem. But I guess you got to launder that money to the public somehow. All right. Next article has to do with mortgage rates or mortgages in general. U.S. new home sales drop further as mortgage rates rise, prices push higher. Written by Lucia Mutakani from Reuters. Sales of new U.S. single-family homes unexpectedly fell in February amid rising mortgage rates and higher prices, which are squeezing out some first-time buyers from the market. Despite the second straight monthly decline by the Commerce Department on Wednesday, sales remained above their pre-pandemic levels. Economists saw reduced affordability curbing activity in the near term, but expected the new housing market to plod along this year, given pent-up demand, a record low inventory, and previously owned homes and strong wage gains. Quote, with interest rates climbing further because of the negative supply shock emanating from the Russia invasion of Ukraine, home sales are likely to trend lower in the coming months, end quote, said David Beerson, chief economist at Nationwide in Columbus, Ohio. Quote, but unless mortgage rates spike or the economy stalls or worse, then the fall off in new home sales should be modest, end quote. New home sales decreased 2% to a seasonally adjusted annual rate of 772 units last month. January sales pace was revised down to 788,000 units from the previously reported 801. Sales surged 59.3% in the Northeast and increased 6.3% in the Midwest, but they fell 1.7% in the densely populated South and tumbled 13% in the West. New homes are the leading indicator for the housing market as they are counted as at the signing of a contract. Economists polled by Reuters had forecast new home sales, which account for 11.4% of U.S. home sales, would rebound to a rate of 810,000 units. Sales declined 6.2% on a year-on-year basis in February. They peaked at a rate of 993,000 units in January of 21, which was the highest since the end of 2006. Mortgage rates surged in February and have continued to push higher after the Federal Reserve last week raised its policy rate or interest rate by 25 basis points, the first hike in more than 3 years, and laid out an aggressive plan to push borrowing costs to restrictive levels by 2023. The 30-year fixed rate vaulted 23 basis points to a 3-year high of 4.5% last week. The data from Mortgage Bankers Association showed on Wednesday. Stocks on Wall Street were trading lower as oil prices rose. The dollar gained versus a basket of currencies. U.S. Treasury yields fell. Though mortgage rates remain low by historical standards, strong home price inflation has combined to significantly increase the typical monthly mortgage payment. Quote, mortgage payments as a share of median family income have risen about 20% from the first time for the first time since late 2007, end quote, said Matthew Pianton, senior property economist at Capital Economics in New York. Quote, this will act to cool the housing market activity, a record low number of existing homes on the market that implies new sales will grind out a small gain over 2022. Data last week showed sales of previously owned homes fell sharply in February. The median new house price in February increased 10.7% from a year ago to $400,600. House prices have risen 31% to 3 years ago. None of the houses sold last month were below $200,000. Strong house price growth is expected to persist this year and into 2023. Quote, we may be approaching a pivot point when higher home costs and higher mortgage rates cool both sales and price increases. But given the supply and demand imbalance, we may not hit that point this year, end quote, said Robert Frick, corporate economist at Navy Federal Credit Union in Vienna, Virginia. There were 407,000 new homes on the market, the highest since August of 2008, and up from 398,000 units in January. Houses under construction made up 65% of the inventory, with homes yet to be built accounting for about 26%. The backlog of homes approved for construction but yet to be started is at an all-time high as builders struggle with shortages and higher prices for inputs like lumber for framing, as well as cabinets, garage doors, countertops, and appliances. At February's sales pace, it would take 6.3 months to clear the supply of houses on the market, up from 6.1 months in January. So, yeah, it's it's kind of a double-edged sword with, interest rates need to go up to curb inflation. But if you're in the home buying market, it's probably going to be real tough or tougher. Interest rates are still very, very low compared to where they were even a decade or more ago. So, what I did was I ran 3 different scenarios here on a $300,000 mortgage. So at today's rate, and this was what was already pre-filled in here. Actually, make that a little bigger. You can see that at 4.51 on a $300,000 mortgage with 20% down, 30 years, you're looking at a monthly payment of about $1,481. Now, a year ago, when interest rates were, say, around 3.5%, that same mortgage was $1,341. So that's a savings of about $140, based on last year's rates. So if rates were to go up to, say, 6%, which again is not, obscene by any stretch of the imagination. I mean, my parents were paying like 12% on their mortgage that they got in like 1978. So, a 6% rate would put you at $1,702 a month. So from where we are today, $1,481 to $1,702. So what is that, about $240? So I mean, it's a significant difference. And then, from where we were a year ago, it's about $340. So $340 over the course of, let's say $340 times 12 months times 30 years. That's an extra $122,000 you'll be paying in mortgage payments. So yeah, it does add up, but unfortunately, that's just where we are right now. All right. Last article I got here is an article about Warren Buffett. Here's what Warren Buffett is reminding everyone about investing. All right. Who wrote this? Brian Sozzi. Warren Buffett is channeling one of his long-held investing philosophies in his recent flurry of buzzy deals, says one fellow value-focused investor. That is, be greedy when others in the market are fearful. Quote, I think he is reminding us that when the tide goes out, we see who has been swimming naked. They left off the naked part here, end quote, remarked research affiliate CEO Chris Brightman. The 91-year-old billionaire investor revealed Monday that his Berkshire Hathaway will spend $11.6 billion to buy insurance company Allegheny. The deal will expand Buffett's insurance empire further beyond auto insurance player Geico and reinsurance beast Gen Re. While diving deeper into the insurance space, Buffett has also gone shopping for energy names, and amid soaring crude oil prices in the wake of the Russia-Ukraine crisis, Buffett scooped up another 18.1 million shares of Occidental for close to $1 billion last week. Excuse me. The latest purchases come hot on the heels of Berkshire spending $6 billion or so in the prior 2 weeks to buy up Occidental shares. Berkshire now owns nearly 14.6% of Occidental Petroleum, though it's roughly 140 through its 140 million shares. The company will hold a key investor day on Wednesday. Interestingly, these deals arrived despite Buffett's favorite stock market indicator flashing overvalued. Other investing pros echo Brightman's sentiment on Buffett's latest moves. They also point to Buffett likely realizing the world will eventually move beyond near-term headwinds such as COVID-19 pandemic and the Russia-Ukraine crisis. I think, quote, I think it reminds me and should remind everyone that the world is still spinning, companies are still planning on the future, and they are still doing the things that make them great companies, end quote, Baird strategist Michael Antonelli said on Yahoo Finance Live. So it's a good thing to remember. Something back in my old days at Ameriprise, one of my mentors there used to say, when there's blood in the streets, that's the best time to invest. And frankly, that's kind of the attitude I've been taking, for the better part of a year now is, what do I, when this all comes crashing down, which, we have pretty good odds that, we're going to have some problems with the dollar. We certainly have a lot of problems with how our government is being run right now. So, so my attitude was a year ago, hey, what is going to survive some sort of, whether or not we go into a bear market, a recession, what assets are going to hold up best and hopefully, earn us some money during that time. So whether or not that's, metals or other commodities, you want to build a little, moat around your, or maybe not a moat, but like a sandbag wall around your property to keep yourself safe and hopefully keep your assets from getting, flooded underwater. So, all right. Well, that's everything I had for today. If anyone needs anything from me, you can go to dsafinancialgroup.com. All my contact information's there if you want to book a meeting or just send me a note. Don't hesitate to do so. I'll be back tomorrow with what day is tomorrow? Thursday. Thursday's Liberty Call. And I hope everyone has a great evening. Bye-bye.